We often have conversations with our clients about the importance of diversifying within a fixed income allocation. And a lot of that has to do with the fact that traditional sources of income in a portfolio aren't yielding what investors are accustomed to. For example, the yield on a 10-year treasury is at or near historic lows. High yield bonds, commonly referred to as junk bonds, are just one example of an asset class that, when added to a portfolio, not only increased diversification, but also had the ability to generate some income. The top chart shows what the yield on junk bonds is, less the yield on comparable treasuries. That's called a spread. So in other words, the top chart shows high yield spreads over treasuries versus the default rate for those bonds. A good opportunity to invest would generally be when the high yield spread is much higher than that of the default rates, kind of like where we are today. We can see the default rates are just a little bit higher than an all-time record low, whereas the spread is still relatively elevated versus treasuries. Also worth noting on this page is the chart on the bottom left, which suggests that even if a high yield bond were to default, on average, you don't lose 100% of your investment. You'll only lose a portion. This chart essentially shows the historical high yield recovery rate. And then last but not least, on the bottom right, we show high yield bond issuance. This is important just because if you're a corporation that had outstanding debt in the last few years, because of the really attractive rates, many corporations were able to refinance their debt and issue new bonds to replace the old ones, putting them in an even better financial situation and probably making it even less likely that they'll actually default.